So we're now going to talk about Chapter 4, which is all about taxes. And I know some of you have already done your own taxes, and some of you are kind of included in your parents' taxes, so it's not really a big issue yet. But as soon as you graduate out on your own, you'll be dealing with a lot of these. So make sure you have your outline with you and you can read across the learning objectives. So here's the sad thing about taxes. About 1/3 of each dollar that you earn goes to pay taxes. 1/3. And therefore, because it's 1/3, you take 1/3 of a year and you end up with in about mid-April. So typically around April 15th, our taxes are due. And that's what we call Tax Freedom Day, because that means that for January, February, March, part of April, you could say, that all the money that we have been working to get at our jobs has gone to the government. And after that, we are free, meaning the rest of the money is now ours. Now, if you're making, less than whatever, $10,000 or even 20,000, the number is nothing like 1/3. That's just kind of average for all Americans. So there's 4 types of taxes that you can pay. You're all familiar with sales tax. An excise tax would be something like on gasoline, cigarettes, alcohol. But we all pay, most of us pay sales tax. There are a few states that don't have sales tax. When you own a home, you're going to have to pay real estate property tax. Very seldom do I see personal property tax, so I don't need to worry about that. And if you are extremely wealthy, have millions and millions of dollars, or your parents do, then you might have to pay estate tax. It's pretty small, or pretty small chance that will happen. Here's the number one thing that we're going to really focus on in this lecture is income tax, because that's what all of you will hopefully have to pay because you're making money. So I mentioned states without a statewide sales tax. Okay, this is without a sales tax. You don't need to memorize this or anything. I'm just showing you the few states that don't have a sales tax. So a lot of things happen when Trump was president. He reduced the tax rates and changed some of the tax structure, so they call that the Tax Cuts and Jobs Act. So when you see that in some of the slides, that's what that refers to. So first thing is, when you're doing your taxes, determining the adjusted gross income, and then you're going to figure out ultimately what your taxable income. So these are a little bit different, and they're a little bit different when you look at this. I know that you don't have this necessarily, this diagram on your sheet there, but so determining your gross income, and these are a little bit hard for you to read, but this is out of your book. This is all the income that you could be getting, whether it's interest, dividends, Social Security, wages from your job, alimony, royalties, gambling, and so on. And then you make adjustments to your income. You subtract them. And those typically would be something like maybe putting your money into an IRA. And then you have what's called adjusted gross income, which is this number right there. Okay? And then we're going to subtract either a standard deduction, we'll talk about those in a little bit, or itemized deductions. So they can either be standard, which the government gives us, or itemized depending on what happens with you. And then we get down to taxable income, and then that's what you use when you're looking at the tax rates to calculate your taxes. So there are different types of income. Earned income, which is the most popular, meaning from your wages or salaries. Investment income, which would be if you got dividends from stocks, interest from bonds, or from rent from investments. Passive income is from activities in which you do not actively participate, like a limited partnership you might be involved with. Then you have other income, as I mentioned before, alimony, gambling, or whatever. So there are certain exclusions from your income, and that's what exclusion would be: tax exempt income. So income that might be from a government bond that you don't have to pay taxes on the interest. It could be tax exempt. That's typically where that comes in. And then we also have tax deferred. So these are two very important terms to know. Tax exempt means it's not going to get taxed. Tax deferred means you're simply deferring it until a later time, typically what happens with your retirement accounts. So your AGI, your adjusted gross income, as I mentioned a minute ago, is your gross income after reductions have been made. Okay? And these are examples of deductions, as I mentioned a minute ago, IRA, maybe alimony payments, tax deferred retirement plans are a type of tax shelter. So often when you put money into a retirement plan, it gets sheltered from having to pay any taxes, and that's the government's way of helping us out to try to save for our retirement. And then in retirement we would have to probably pay taxes on them. So then a tax deduction is the amount subtracted from the AGI. So each taxpayer can subtract, so these are important terms here, either a standard deduction or an itemized deduction. So the government gives all of us, so for example, let's say you have $100, I'll just make it more realistic. You made $100,000 and the government says, okay, you have a standard deduction of like $20,000. That's not the amount, but it's close to it. And that means we're going to take your taxes based on $80,000. Well, it's possible that you have more than $20,000 in deductions. So for example, you might have your mortgage interest you paid on your house might be $15,000. You have other maybe real estate taxes you've paid as maybe $10,000, something like that. Okay, so you've got $25,000 right there that you potentially could deduct from your $100,000. Okay, now $15,000 is awful high, and I think there's some limits as to how much of both of those you can deduct, and it's usually if you're pretty wealthy. But anyway, the point is there could be a number of these itemized deductions, okay, and if they add up to more than what the standard deduction is, then you'd want to itemize them. It just means it's a lot more work with your taxes. You got to fill more papers out and so on. Okay? But the government recently said, hey, let's just raise this number so we don't have to deal with figuring out if people are lying or cheating or whatever. We'll just give everybody a higher standard deduction. Okay? So here are examples of itemized deductions. So for example, I just mentioned mortgage interest and real estate taxes. Okay? So there are other ones there. Those are typically some of your bigger ones. Sometimes you have major medical expenses. You can deduct those and so on. So there used to be a thing called exemptions a couple years ago, and this TCJA, the act that changed taxes, basically kind of did away with exemptions. It allowed you to kind of lower your taxes a little bit, and they basically just said, well, let's just raise the standard deduction amount. So we're really not going to focus on exemptions. So here's another example on your sheet there. You can look at all the steps. You have your gross income. Maybe if you made a retirement plan contribution, there's your AGI, and then your standard deduction of $24,000, and then there's your taxable income. So look, when you get a salary of $81,000, you may think, gosh, I got to pay taxes on $81,000. Well, it's often not anything close to that, because by time you get down here, that's almost 30 grand less that you have to pay taxes on. So we are known as having what's called a progressive tax system, and that means that as you make more money, your rates go up. Okay? And I'll show you exactly how that works here in a minute. These are what we call the marginal tax rates, meaning on the last and next dollar of your taxable income. Okay? So I'll show you how that works in a minute. So I want to make sure you understand the difference between a marginal rate and an average rate. So average is as it sounds. For example, a person with an income of $40,000 and a tax bill of $47.40. So we'll get to how you calculate that in a minute. he would have an average tax of 11.85%. You're just simply taking the 4740, dividing it by 40,000, and then on average you pay 11.85%. That's it. It's simple as that. The marginal tax bracket simply means that if you made one more dollar, what would it be taxed at? Because your income is taxed at different rates, okay? And I'll explain that here right now. So for example, most of you are going to be in this category, single filers. So let's just assume you're making $50,000. So 50,000 would fall right in here, 22% rate. Now, this is the most misunderstood aspect of taxes. Most people think you multiply 22% times 50 and that's your taxes. That is wrong. Everybody pays the rate of 10% for the first 98.75, assuming they're a single filer. Okay? And then the amount of money that you make in between this range is taxed at 12%. Okay? So let me go to this next slide. So here's the 98.75. 10% of whatever that is your taxable, times 10% of your taxable income is what your taxes do. Now, if we go, let's say you made $20,000, which is right in here. You would take the $98,987, which you got from up here, 10% equals $987.50. Okay, that goes down there now. And then 12% over this line right here. Okay? So if you made 50,000 again, your 50 is right here. This, whatever the difference is between these, that's about $30,000. 30,000 is going to be taxed at 12%. And then the remaining, if you're making 50,000, then your remaining 20,000 that would be in here would be taxed at 22%. And these rates over here are what we call the marginal rates. Marginal rates. So everybody, regardless of where you are, you're going to be paying a 10%, a 12%, 22%, various percentages as you make more. And this is why we call this a progressive tax rate, tax system, because we pay more. Okay? So one other thing I want you to mention here. So head of household simply means you have at least a child living in your house. And so the difference between these is that you're allowed to make a little bit more, okay, at 10%, for example. Married filers can make a lot more because you got two people. And the standard deduction here changes a little bit when you have a child. You get to deduct more, which means your taxes would be less. So you're getting kind of a benefit by having a child. Of course, a child is going to cost you a lot of money too. Okay? So I'm now going to play you a video. It's only a couple minutes long, if that, kind of explaining what I just explained.
For 2019. Simple, right? But many of us make a common mistake.
Let's try that again because the sound seemed to be down.
These are tax brackets for 2019. Simple, right? But many of us make a common mistake when looking. You might think that puts me in the third bracket, so I would owe the federal government 22% of my income. This is wrong, and it's causing us to have uninformed debates about tax policy. Here's how it actually works. Let's go back to my $84,000 income. Now, instead of thinking of tax rates as brackets, we should think of them as pockets. But first, there's one special pocket we need to talk about. The money we put in this pocket is not taxed. The government automatically lets single people put $12,000 in this special pocket, and more for couples. But if you spend a lot of money on things like medical expenses or charitable donations, you can sometimes put in more. These are called deductions. With the $70,000 that's left over, you can start filling up the pockets. The first pocket only has room for $9,700, so I only pay 10% on this money. Then I pay 12% on the money in the next pocket. and then 22% on the money in this pocket. These are called marginal tax rates, and that's how these brackets actually work. So if I get a raise, that new money goes into the first pocket with empty space. When space runs out, we put it in the next pocket. So the raise, and only the raise, would be partially taxed at 22% and partially at 24%. So when politicians say they want to raise the top tax rate, it doesn't necessarily mean these pockets and their money are affected. They're talking about tax rates on the pockets way over there, which are only used once people have filled in these smaller ones. Marginal tax rates are a pretty simple concept once you get the hang of it. So the next time a politician says the government wants to take away 70% of your income, just send them this video.
Okay, so what a lot of people don't realize is how tax rates have changed over time. And so right now, this is the top bracket, and you can see, and this is unfortunately it's like 2008, but really the top bracket hasn't changed. We're still kind of right in that area. But we have been as high back in the war times as 94%. And when you look at where we are now, okay, we're historically very low. So we've got some of the lowest taxes that we've had over the last 100 years. So anyway, pretty scary time living in this. Now, I'm not sure how much you had to be making to get 94%, but still, I imagine that meant a lot of other taxes were pretty high too. So a tax credit is an amount subtracted directly from the amount of taxes. So tax credits are a big difference from a tax deduction. So it's important to understand that 100% tax credit reduces your taxes by $100. So that's a dollar for dollar you don't have to pay. But if I have a $100 tax deduction, so for example, if I give $100 to charity and I'm in the 25% tax bracket, a lot of people say, well, that's a tax write-off. It is a tax write-off, but if you give $100 to the charity, you're really only benefiting by $25 because you still have to pay taxes. You're just reducing your taxes, your income by $100. So you don't have to pay $100 times 25% or $25. Okay. So here's some examples of tax credits. I'm not going to read those to you. So I want to talk about making tax payments. So most of you, when you've had a job, you noticed on your check stub that you have, like what they call federal withholding. Okay? Federal withholding. And it just simply means that, so when your employer pays you, they estimate you're going to make whatever, $50,000 a year. And so based on that, they figure out how much income tax you would probably have to pay the government. And so each check, so you get a $1,000 check, a weekly check or whatever, and then they might have whatever, $200 taken out in withholding. And then your employer sends this to the IRS. Then at the end of the year, so let's say you did that 52 weeks, that would be whatever, 10,000, what would that be? 400. And let's say that your actual taxes were $9,000, okay? So that's what you paid, and then these were your actual taxes, $9,000. That means that you would get a refund of $1,400 because you gave the government, your employer paid the government, you paid them, they just took it out of your paycheck and sent it to the IRS, and you get a refund. Okay? So that's when we're happy at the end of the tax year that we know we get money back. Okay? There are times, of course, where this number is lower than your actual taxes and you have to pay. Okay? And if if you're like a business owner where you don't have someone paying you a salary, then you have to make estimated payments to make sure, because the government, the IRS doesn't want you to wait till the end of the year to make your payments, because they want, because of time value money, they want to make sure that they're getting their money, they can invest it, and they also want to make sure that you have plenty of money to be able to pay it. So as I mentioned earlier, most people have to pay their taxes by April 15th, give or take a day. You can get a 6-month extension if you need to. And it is so important to make sure that if for some reason, even if you don't have the money or whatever, you file an extension, because if you don't and you owe taxes, you could be paying a penalty easily up to 25% of your taxes. So key thing, pay your taxes on time or file for an extension. So this is a form that your employer would send to you. So box 1 and 3 and 5 are different. Notice this one's like $4,000 difference because the employee must have had like a $4,000 deduction that they didn't have to pay taxes on, but they still have to pay Social Security taxes on. So a certain percentage of your salary goes to Social Security and a certain percent goes to Medicare. This is the insurance that you get when you turn 65 from the government. So you are paying a very small amount kind of each year to help pay for insurance when you get older. And this is to help fund your Social Security that you would get once you typically turn 65 as a very small part of your retirement. And this is the form that goes to the IRS. So who must file with taxes? Well, all pretty straightforward. You can be married, filing joint returns or separate returns. You can be a widow, head of a household. Those are your standard 5 categories. Remember I talked about the Tax Act a couple years ago. We used to have a number of different types of forms, standard 1040 EZ, A, and a few others. Now there's only one form. It's simply Form 1040. Okay, so that's the form all of you would have to fill out. And there are still about 800 forms to report additional income, but most of us can get by simply with that form. So in terms of completing it, I'm not going to read all of these. This is pretty straightforward. Some kind of trivia. All states have a state income tax except 7 states, and I'll show you those in a minute. And tax incomes rates can go between 1 and 10%. So not only do you have federal income tax, you also have state income tax. Fortunately, states a lot less. So here are the states that do not have personal income taxes. That's why a lot of people like to move to Florida. A lot of rich people move to Florida because they have no personal income tax. And a few states, pink ones here, have no corporate tax. And this is kind of straight. These 2 yellow ones they have no taxes on dividends or interest. So anyway, it's something to think about if you're really wealthy and you're retiring, where you might want to move to if you're still making a lot of money. And then these are the top kind of marginal rates in all of the states. Here's Ohio. It's about close to 5%, and you can see that most of them are around 5%. California's pretty high. A lot of people want to move out of California because those rates are so much higher. And of course, you notice these states don't have anything because they're the ones that have no state income tax. Now, just because they don't have state income tax doesn't mean it's, not expensive to live there. They might have higher personal property, real estate taxes. They might have higher sales taxes, but still, it's a pretty good chunk that you don't have to pay. So where can you get information? Of course, the IRS has, all kinds of places. They even have an app, and there's other zillion online resources, publications. You can read those. Most people today use software to prepare their tax. TurboTax is one of the top preparation softwares that people use, and they can just submit them electronically to the IRS. There are a number of tax preparation services. I use an accountant because tax laws change all the time. I don't want to take the time to keep up on it. And I'm happy to pay a few $100s to have all of that done. And by somebody that knows a lot more than I do. Sometimes you go into Walmart and I think you see H&R Block can help people. So here's the thing to remember. If your professional taxpayer makes a mistake, you are still responsible. Okay? So hopefully you pick someone that's reputable and doing a good job, and that's why it's always good for you to kind of understand something about taxes, to look over them to make sure that it makes sense what you're doing. So I'm not going to read through all this, but if you, because I know most of you really aren't into filing your taxes probably right now, but of course you can always pause this and read it, but it's how to file your taxes online. Okay. So what if your return is audited? So that's what we call a tax audit. And fortunately, it only happens to about 1% of us. It's 1% each year. I was audited, oh gosh, I don't remember, like 20 years ago. And it was kind of nerve-wracking. My accountant went with me, and it ended up I got more money back than I had claimed, because we found a mistake that my accountant had made that benefited me. So it worked out pretty well for me, but a lot of times it doesn't. And there's various types of audits. I don't want to spend much time with this because chances of you guys getting audited are really, really pretty small. But if you want to reduce your chances, so for example, if you claim large or unusual deductions, you are going to be more likely to be audited. They don't just randomly say, okay, we're going to pick 1% out. They're going to tend to pick people out that are making a lot more income and people that have really kind of strange income statements with deductions and so on. Okay, tax planning strategies. So it's important to note, legal versus illegal. So legal is tax avoidance. So meaning I'm going to try my best to avoid to pay taxes. And I know that can sound kind of criminal in a sense, but these are legitimate methods to reduce your taxes. For example, putting some of your money into a retirement account that defers the taxes until you retire, so you're avoiding paying the taxes today. Nothing illegal about that. Tax evasion is when you illegally are not paying your taxes that you owe. So the number one way this happens, especially with small business owners, is if people pay them in cash, they don't record it as a sale, and they just put it in their pocket, and therefore their sales are less than what they actually made, and that is considered tax evasion and illegal. So the biggest tax deduction that most people have is mortgage, interest, and property taxes. Those are by far my largest. And that's a benefit with you owning a house, is that you get to reduce your taxes. Most consumer debt, like credit cards, you don't get to deduct. However, if you have a home equity loan, which you could use that home equity loan to buy a car, you could use it to pay down your credit card. Home equity loan interest can be deductible on your taxes. And sometimes moving relating to your job can reduce your taxes. In terms of investment decisions, we have tax-exempt investments, which we talked a little bit before, and tax-deferred. So remember the difference with tax-exempt and tax-deferred. Tax-exempt means we just basically are not going to have to pay those taxes, or taxes on typically interest. So we have interest here on various types of bonds. Okay. Tax-deferred means that if I put my money in, say, an IRA or a 401k, I am deferring the taxes until I take them out, which is sometime in retirement. Okay. Capital gains taxes are taxes when we sell stocks or bonds, and if I don't sell them, so if I buy Tesla stock today and I don't sell it for 5 years, I don't have to pay any taxes on it, on my gains, even though my money might have doubled in year one. I don't have to pay any taxes until I sell it. So I'm kind of deferring my taxes until then. Then we have kind of education and retirement plans. These are, as I mentioned before, they're kind of on the last slide, they're tax deferred. This is probably the one that's going to be the most popular for all of you. It's what most financial planners would suggest you start, like even right now, or especially when you graduate. Start a Roth IRA, a 401k plan, and we'll talk a little bit more about these later in the semester. This would be offered by your employer, and it allows you to put money into like the stock market, and you don't have to pay any taxes on any gains until you take it out. And often your employer will match it, meaning typically with your salaries, you're looking at anywhere from like $2,000 to $5,000 they will put into your fund if you continue to work with them for a few years. So this is by far one of the best things you should be thinking about. So we talk about emergency fund, last chapter. You need to make sure you set that up. And then if your employer has a 401k, you have to do that. I mean, you don't have to, not by law, but it's one of the best financial decisions you'll make because they're matching up to a certain point of what you put in there. Okay? So, some tax saving strategies. I'm not going to read through those. They're pretty straightforward. And that's it.